Joining us today on the show to answer all of your queries is Anil Rego, founder and CEO, Right Horizons.
So constantly, just the big news headline that we saw on Friday that took the markets to a tizzy was the Moody's rating, and the big upgrade. It's definitely a big thumbs up, a lot of conviction for the government given that it came after 14 long years. What would you, in just the broader sense, for investors who don't track the equity markets on a regular basis, can you help us understand, or help these investors understand, what exactly is the impact when a ratings agency, gives a positive rating on a country, on the overall macroeconomic picture? What's the impact on mutual funds?
In India here, we're looking for a rating upgrade, and it has many positives, especially for markets. One is that on the equity funds, you would find that it is positive because you would have a lot of pension funds and endowment funds which have restrictions based on the credit rating of the country, and based on that they can invest in a country or not invest into a country. Because these are risk measures that their boards have for them. So you could see a lot more money coming in from pension funds and endowment funds which have not had a presence in the country. You would also start seeing a lot more confidence that it is conveying to equity markets, equity investors, the macroeconomic. You would also find that the rating improvement actually ends up reducing debt costs to companies, which in turn especially who are borrowing overseas, and that could result in cost saving and higher profitability, and therefore the equity returns also could be better. You would also see that because of the better credit rating, again, overseas investors can also start looking at debt funds a lot more actively, and this may again bring down interest rates as a whole, which could both impact debt funds, wherein long-term income funds can benefit. However, what we would suggest is either you look at corporate bond opportunities fund in a better environment, or even a short-term income fund, because long-term income funds can also be volatile on both sides. So this is definitely a great positive both for equity as well as debt markets. However, let's say for somebody who's putting money into bank fixed deposits, for example, it may not be a great thing. So you may continue to see money moving from FDs into mutual funds as a result of this, and that will also end up adding better returns on equities.